Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about SoFi Technologies, Palantir Technologies, and NEO. Starting off, we're going to dissect an article titled, SoFi Stock Gains 7% as Analyst Raises Price Target. After that, we're going to move on to talking about Palantir Technologies regarding how the AI industry is absolutely booming right now, and how this could translate to a higher PLTR share price. After that, we're going to dive into how Palantir ranks against other AI and artificial intelligence companies, and if they are still a good buying opportunity, while also going over their latest news updates and projections. Lastly, we'll discuss NEO's NIO stock and how they are primed for future growth due to some approaching catalysts, such as them making new vehicle models, them building their own in-house production facility, and how they plan to further infiltrate Europe. And then we will conclude with our last story where we will ask ChatGPT, or at least analyze an article that has asked ChatGPT, which is an artificial intelligence platform, what NEO stock could be by 2023. So for more news updates just like this one, remember to go and annihilate that like button, subscribe if you are new, comment down below which company you want me to report on more between SoFi, Palantir, and NEO, and now let's jump right into today's stories. If you're not familiar, SoFi Technologies is a fintech company or a financial technology company that essentially operates as a completely digital bank. They can do anything a bank can do, but all from your phone through their very inclusive app. SoFi recently has smashed through the wall of various investor worries, considering that they had a phenomenal earnings report, and recently they have reassured investors and stakeholders about their future projections. Even analysts are reassuring investors that this company is primed for future growth potential. Specifically, a Mizuho analyst believes that the criticism regarding SoFi Technologies is completely overblown and overstated, to where this analyst actually raised his price target, unlike other analysts and investors who are more scared, saying that this company will continuously trend downward. He says that the current share price could surge from $6 up to $9 over just the next 12 months, which is extremely bullish. The analyst clearly kept his buy rating on the company, and according to Motley Fool, they project that Palantir could exceed $2 billion regarding their revenues for the entire year of 2023, which is very bullish and positive. Investors are still somewhat high from their very impressive fourth quarter 2022 earnings report, where the fintech company brought in an impressive beat in regards to their overall revenue, beating forecasts. This has made investors look to 2023, which is the year we are in right now, to see if they can do it again. Management reiterated their overall positivity and bullishness for their future projections, because management expects that the full year of 2023 they could bring in adjusted EBITDA between $260 million to $280 million, while analysts are less bullish, thinking that the company should bring in around $246 million. So once 2023 ends and they bring in these projections, or even EBITDA that's close to this on top of a revenue beat, this could cause the overall share price to absolutely skyrocket. And it's great news to see that management's projections are higher than Wall Street's projections, meaning that we could anticipate future earnings beats, which could increase the overall share price. So where does this leave us? Where could the SoFi share price and the SoFi stock price, or the SoFi stock price, be in 2023? Well, so far throughout the year of 2023, the company has jumped by around 59%. But we do need to make sure that we're taking into consideration the prior year, where the company actually lost around 43% of its value, and now SoFi is trying to climb back the ladder from their overall losses. The main reason for this is not due to the fundamentals of the company, considering that the fundamentals of this company are very strong. The company also has approaching catalysts, such as the student loan moratorium ending, and other catalysts in store, such as approaching earnings reports. But the main reason why SoFi stock fell last year and is still trying to stabilize their price this year is because of macroeconomic factors. The Federal Reserve has a hawkish monetary policy right now to try to get inflation under control, and this would require the Federal Reserve to increase interest rates. So logically, borrowing costs are going to increase with higher interest rates, which is going to de-incentivize borrowers from taking out personal loans, refinancing student loans, getting car loans, and other things of that sort, which are all things that make SoFi Technologies money, considering that the majority of SoFi's revenues come from their lending segment. So with that being said, as soon as the Federal Reserve starts to ease off on their hawkish monetary policy and they become more dovish, thus lowering overall interest rates because inflation is becoming under control, this is going to slingshot SoFi stock well into the future, and I'm excited that the company could surge up to $9 throughout the next year from their current share price, which is close to $6. So I would love to hear your thoughts down below on this story. Now let's move on and talk about Palantir Technologies, which is a big data and analytics company which serves both commercial enterprises as well as government clients. Palantir has fantastic technology that allows organizations and the government to make data-driven decisions, and Palantir is primarily an artificial intelligence play along with other companies such as C3.ai and other companies, but we're going to primarily focus over on Palantir Technologies. As you know, shares of big data and artificial intelligence focused software companies, such as the ones previously mentioned, have been hit very hard lately, considering that they've been down 8.3%, 6.9%, and 6.4% respectively. Across the board, we have seen a dramatic decline in the share price of companies in the growth and technology space. And this has had nothing to do with how the companies themselves are performing, because honestly, all three of the companies in this article have performed quite well fundamentally, but the reason their share prices are being weighed down like an anchor is for two reasons. Similar to SoFi, these companies are being weighed down by macroeconomic factors, and on top of that, we've seen a decline in very aggressive technology growth stocks due to an increase in long-term bond yields. So I'll talk about the relationship between 10-year treasury bond yields and how the stock market will react to these. So for instance, recently the 10-year treasury bond yield rose to around 3.92% as of this video. However, what does this mean for the stock market? Well, normally when bond yields increase, the stock market, particularly risky growth companies, tend to decrease, because from a risk to reward standpoint, investors can get very safe growth by investing and putting their money into 10-year treasury bond yields instead of taking on unnecessary risk by investing into the stock market during times of stock market uncertainty. Essentially, a 10-year treasury bond yield is an IOU from the government or whatever institution is giving them out, so this is a much safer way to make money during a very volatile time in the overall stock market. That's why when bond yields go up, investors tend to take their money out of risky growth stocks and put them into safe 10-year treasury bonds. Investors will cycle back into the stock market, which honestly gives investors a great buying opportunity to get their favorite technology growth companies at an even cheaper valuation. Another reason why bond yields and treasury bond yields negatively impact overall share prices, specifically regarding technology growth stocks, is because these companies' valuation are contingent upon the intrinsic value of their present value and their future cash flows. Essentially, the present value is determined in part by interest rates plus a risk premium. That means for companies like C3.ai and Palantir, which are all growth stocks and technology stocks, this has not fared very well for them. Now, what are these companies doing fundamentally? Are they still good companies? I would say yes. The company is surely showing their strength, especially after they brought in their fourth quarter earnings report, which showed a solid increase in their revenue, their earnings, and they also had a GAAP net profit earnings surprise, which caused and ignited their overall share price to increase, which was fantastic for the PLTR stock. However, there is some uncertainty approaching for Palantir Technologies, but I think could actually translate into a catalyst for the PLTR stock, and here's what it is. The government appears to be assessing whether or not Palantir is worth the price they pay for their software. Essentially, the government is trying to find a lower cost software to replace their Palantir software, considering that Palantir software is very expensive. And if the government decides to not renew their contracts with Palantir, this is going to drastically negatively affect the overall share price and the company, considering that the majority of Palantir's revenue comes from the government segment, particularly 4 government contracts make up a huge portion of Palantir's overall revenue, and if they lost those giant government contracts, this is going to negatively impact not only the company fundamentally, but also their share price. Now, for me, I don't think the government will kick Palantir to the side. I think the government will renew the contract with Palantir Technologies, because when is the government concerned about spending? They spend money all the time, especially when it comes to military prestige and technology, specifically Palantir's technology, which is being utilized over in Ukraine right now. So I don't think Palantir is actually at a large risk of losing these government contracts, but this is definitely something that you need to be aware of as an investor. There's no doubt that big data and artificial intelligence is the buzz of the market right now, and by investing into Palantir early, you may be able to benefit from its long-term growth trajectory, even though in the short term, the company could lose some overall value in their share price. Yet artificial intelligence and the big data space look very promising going forward, which could mean that this company is a fantastic long-term investment opportunity. With that being said, what do professionals think about this particular company? Well, recently, Zacks Rank has a number 2 rating on Palantir Technologies, and if you're not familiar, Zacks has a spectrum that ranges between 1 and 5, where a rating of 1 would mean a strong buying opportunity and the rank of 5 would mean a strong selling opportunity. And recently, Zacks has a number 2 rating on Palantir Technologies, making Palantir not a strong buying opportunity, but rather a buying opportunity nonetheless, to where they believe the share price could surge up to $9.09 over the next 12 months from its current share price trading at around $8. And although that doesn't sound very impressive, the future growth of this company is what investors are actually betting on, not the short-term growth of this overall company. So I would love to hear your thoughts down below. Now let's talk about NIO stock, because I'm very excited about this company, even though there are risks. If you don't know, NIO is an electric vehicle manufacturer that is located over in China. And as of late, they have had very good reports coming out about them, particularly right before they released their earnings on March 1st. This company is also anticipated to release multiple catalysts which could increase the NIO stock price. For instance, the NIO stock price could increase due to the company's catalyst of building their first electric vehicle battery plant. According to Reuters, the company is setting up a new battery plant next to its manufacturing facility in eastern China. On top of that, this plant is anticipated to be able to have an annual capacity to manufacture 40 gigawatt hours of batteries annually. And what does this mean? Essentially, this means that they have the potential to power about 400,000 units of long-range electric vehicles, which is phenomenal. At the same time, NIO is also trying to build other factories to make more affordable electric vehicles to sell to Europe, thus further infiltrating their international footprint. So NIO remains a very well-positioned growth company to further drive their overall revenues higher as they continuously build out their own battery facilities, their new manufacturing facilities, selling to markets over in Europe, and they also have another catalyst to where they are planning to release 5 new electric vehicle models in the first half of 2023. And this, I think, will not only increase their overall revenue, but also diversify their overall revenue sets. Thus, they're going to be able to appeal to a broader market over in China and over in Europe. This is going to allow them to steal more market share. On top of that, other very bullish signs and positive signs for this company is that China is reopening their overall economy, their supply chain issues are starting to become under control, and Wall Street seems cautiously optimistic about NIO stock to where NIO stock has a moderate buy rating. Right now, the company has 6 buy ratings, 3 hold ratings, and no sell ratings from analysts that were surveyed. These professionals, on average, think the company is worth around $17.13, which means investors could anticipate a 75% surge in the share price over the next 12 months. And this would be one of the best investments to make right now if analysts are correct, but we do need to take these price targets with a grain of salt, considering that we always need to make sure to do our own research to make sure this company aligns with our risk management policies, your age, investing strategy, and other variables. Lastly, let's end with asking ChatGPT, which is an artificial intelligence platform by OpenAI, which Microsoft is investing heavily into, what NIO stock could be worth by 2030. This institution actually did exactly that, and this was ChatGPT's reply. A possible trading range for NIO's price by 2030 could be between $50 to $500 per share. This range is based on several assumptions and variables, including the level of demand for electric vehicles in China and other markets, the level of competition from other EV manufacturers, and the impact of NIO's partnerships and collaborations on the company's future prospects, end quote. If you want to see down below, we actually have a range of certain price targets that this company could achieve throughout the next few years. And honestly, I think these price targets are rather fair, to where the company could end 2023 with a little growth of $13.85, then for the year of 2024, it could surge by $7 up to $20.18, being worth as high as $51.83 by 2030. If you look at the overall price segment increases, you can see that you could have over 400% in returns for this company, making it one of the best buying opportunities. However, there are risks involved with NIO, and you need to be aware of these. Trust me, please don't go all in on any singular risky growth company, let alone NIO, because one, that would be improper risk management, and two, you need to weigh the risk to reward. I personally have an allocation to this company that's less than 5% of my overall portfolio because I like to practice proper risk management. But here are the risks for this company, and trust me, they are big. The first one is competition from other electric vehicle makers such as BYD, XPeng, Li Auto, Tesla, and other electric vehicle companies. NIO is going to have to further differentiate themselves and innovate their own technologies so they can have a competitive edge in their overall market. Another problem with this company would be geopolitical tensions between the United States and China. If geopolitical tensions increase, we could see Chinese stocks actually fall in their overall share price, which would be terrible. Lastly, some investors believe that NIO could be delisted from the overall stock market, considering that NIO is not meeting proper demands for various auditing practices over in the United States. But there is so much more to that particular story, I may do another video just on that. In the end, I think the geopolitical problems are going to be the number one risk for this company, followed by competition, and then lastly, it would be the delisting risk. But overall, these are things that you need to be aware of, and if you want more videos just like this one, remember to go and annihilate that like button right now. Subscribe for more videos on SoFi Technologies, Palantir Technologies, and NIO stock. Remember to go and comment your thoughts down below. I'd love to hear them, and without further ado, I will see you in the next YT video.